All right, so mortgage rates have been a major topic of conversation lately, mainly because of where they are sitting today and how they are impacting housing affordability. And this article that I'm going to share with you from Fortune talks about what would actually need to happen in order for the housing market to normalize. In fact, the title here is that the US housing market has gotten so expensive that income would have to jump 55% in order to make buying a home affordable. And now they're not talking just about income. They also talk about what would have to happen with housing prices and or mortgage rates. But before we jump into the details of this article, if I could ask one small favor, please hit that like button and consider subscribing. It really helps grow and promote the channel, and I would certainly appreciate it. There is one undeniable fact about the US housing market, and that is that it is just not affordable for the majority of potential home buyers. And as of right now, housing affordability is at an all-time low. Now, this article goes on to say that it hasn't been cheap to buy a house in decades, if ever. I would slightly disagree there. I mean, if you go back to 2010, housing prices had reverted to their historic trend line, or at least very close. At that point, I would consider that to have been relatively cheap. In addition to that, when mortgage rates fell to the record lows, they were sitting like at or below the 3% range. Housing prices may not have necessarily been cheap, but the mortgage rates or the debt certainly was. It made it substantially more affordable to purchase a home. Over the last few years, we saw this massive run up in prices. And they say that a lot of this had to do with remote work and hybrid work and how it expanded the map for millions of people, allowing them to work remotely. And a big cohort there that was entering their prime home buying age, of course, was millennials. It's one of the largest cohorts. But if you were to ask me, I think that one of the primary drivers for price appreciation over the last few years, of course, was the lower interest rates. With that said, let's go ahead and talk about what happened in 2022. This, of course, affected everyone, but they say that it shocked primarily the 40 and under crowd as mortgage rates went from the 3% range on up to more than 7%. This happened in less than a year's time. So the chart on the mortgage rates, I mean, it really just skyrocketed. And this started, I think, February of 2022, and then just kind of continued up dramatically. So we went from pretty much record lows to rates that we haven't seen in over 20 years. Yet there's decades of underbuilding, meaning new construction, which kept a floor under prices. Now, mortgage rates hit just over 7% in 2022, but as of today, the national average is sitting somewhere closer to actually 8%. We're right between 7.49% and I think 7.75% as of this recording. And according to Andy Walden, who is the Vice President of Enterprise Research for ICE Mortgage Technology, if mortgage rates and housing prices were to stay exactly the same, he calculates that the US incomes would have to increase a whopping 55% for the housing market to be considered affordable again. And then he goes on to tell a reporter from CNBC, if you look at home affordability itself and what it would take to normalize the housing market today, it's a 35% correction to price or a 4% decline in interest rates. In other words, we'd have to go from 7.5% down to 3.5%, or a 55% growth in income, or some combination of all three of those. But just imagine housing prices actually falling 35%, or your boss giving you a 55% raise. Of course, that doesn't seem very likely right now, especially when we're dealing with a very low level of housing supply or housing inventory. And then, of course, this article reiterates that other housing industry experts share the same view. In other words, we shouldn't necessarily expect that mortgage rates or home prices are going to go down anytime soon. Unlike the turn of the millennium, housing prices today are rising alongside mortgage rates primarily due to low inventory. These headwinds are causing both buyers and sellers to hold out for better circumstances. Demand has actually hit its lowest point over the last 3 weeks, and this is constraining the market and impacting affordability, putting it at its lowest level in 40 years. And to really drive the point home about affordability, I pulled up a chart from long-term trends. This is home prices compared to median household income. In other words, how many times over is the housing prices compared to the median household income. So for instance, if we go back to the GFC, the home prices were nearly 7 times the median household income. And of course, as this chart indicates, we were in a housing bubble. But if you take a look at where we are today, home prices would be 7.4 times the median household income. And if we were in a housing bubble back then, Where does that leave us exactly here today? All right, that is going to wrap it up for today's video. I would love to hear from you. Where do you think this housing market is headed? Do you believe that we will see a 35% correction in housing prices, a 4% decline in mortgage rates, or even 55% growth in income? Me personally, I think it'll be hard for either one of those scenarios to play out completely, but perhaps we will see a combination of all three, bringing housing back to a more affordable level. I just don't know that it will happen to that great of a degree.